like to introduce our first keynote of the day. SmallCap Discoveries is the lead sponsor for the Planet MicroCap Showcase Vancouver, and you've probably heard a number of our podcasts over the years, and I'm very thankful to call Paul and Trevor from SmallCap Discoveries good friends, high quality folks in this space. So without further ado, Paul Andreola from SmallCap Discoveries.
Thank you, everyone. Yes, my name is Paul Andreola. A little bit about me before we get on. I am a microcap investor. I live and breathe this stuff. I'm also a director of a couple companies. I'll mention those a little bit later on and fully disclose which ones. Like I said, we live and breathe this stuff, and we think there's a set of criteria that that if you follow will help you sort of discover companies that could literally change your financial future. So SmallCap Discoveries itself is the platform to help our members, find those companies. And, it's a newsletter forum. We do company interviews and a lot of educational resources in there. So my goal today really is to inspire you guys to kind of do the right things and help you find those kind of companies that we think could, like I said, change your financial future. And using the criteria that I'm going to explain a little bit later, has allowed me to actually have found some companies that have changed my financial future. So, what we're going to talk about here is multi-baggers. I've been fortunate enough that I've actually discovered a couple companies that have gone on to generate over 100 times return in value. And of course, that category is where we're playing right now, the microcap space. Strategy I've used has really been inspired by a number of books. These are three that made a big difference to my life. How to Make Money in Stocks. If you haven't read that, I highly, highly recommend this book. It really determined or changed the way I was thinking. If anything, it sort of flipped upside down the way I thought about microcap investing. What Works on Wall Street, why this book is really important. Anybody who's in the microcap space should has to read this book. It will solidify and validate why spending time in the microcap space is going to make a difference. Basically what they did there is they took a look at over about 100 years worth of data and really proved that operating in the microcap space with a specific kind of criteria will help you find those kind of companies that will change your life. And of course, 100 baggers, Chris Mayer, again, will help you define what it's necessary to find those companies. And historically, he's gone back and looked at a bunch of companies that have returned 100 times in value. Okay, to be successful, obviously, you have to know where to look. And the person that turns over the most rocks wins the game. Of course, that's Peter Lynch. And to do that, you need a repeatable system that helps you go through the thousands and thousands of companies that are out there to find the ones that make the most sense and give you the best chance of success. Part of what we're doing here today, obviously, all the companies we're going to meet, management teams we're going to see, should be part of that process. Okay, so the odds you're facing right now, just in Canada, there's roughly just over 2,700 companies that are publicly listed. Sub 500 million, you've got just under 2,300. Now, as of last quarter, 313 of those companies actually showed a profit. So you've only, less than 14% of the companies that, in the Canadian microcap ecosystem is profitable. You need to flip over a lot of rocks. That chart there is the VSE index, or I call it the VSE index, the TSX Venture Exchange. And you can see over the course of the last 20 or so years, it's not exactly been an easy place to find winners. Okay, so what do you need? You need a repeatable search system. You need definable criteria, and you need tools. And by this, I mean either screening software. What Trevor and I do with SmallCap Discoveries is we actually go through every CDR filing in Canada manually. Of course, once you find companies, you have to have a monitoring criteria. And then lastly, you need time and patience. You need to let these stocks do their magic. And of course, buy and hold does not mean buy and forget about it. If you find the company, you're going to have to spend time monitoring it, making sure it continues to fit your criteria. Okay, so the key criteria that we use to find companies that will return those kind of numbers that I talked about. You have to find a company that's got hyper growth, right? We don't necessarily look in the value bin. We're looking for companies that are growing rapidly. And by hyper growth, we mean 25% growth or more per share. Low price to growth per share. So those that know PEG ratio, we use the PEG ratio to really determine if something's overpriced or underpriced its growth. We look for companies that produce high returns on invested capital. And we really try to understand, especially these profitable companies with cash, what are they going to do with that cash? How can they reinvest that cash at a high rate of return? And then last, and probably the most important of what we do, we try to understand the discovery process. Our program is called SmallCap Discovery specifically because of what we believe happens in a stock that goes from unknown to known. And the fact that we're dealing with the small size companies is even more important because that's really going to determine kind of how mispriced it is and where the potential price could go to. Okay, so when I say hypergrowth, like I said, 25% growth from revenue per share or greater. We want to see growth in earnings per share of at least 25%. And these are early stage sort of inflection points, so we want to see at least 2 quarters of profitability. If you use just those 3 criteria, we think you've shrunk that original sort of 2,300 companies probably down to 10 or 20 per year. Low valuation, we're looking for a PEG ratio of less than 1. We want to see low enterprise value to cash earnings. Of course, earnings can be a little bit iffy if it's not really cash-based earnings, so we want to make sure that that these earnings are being converted over into cash. And of course, we really need to understand the financials, so really what's happening sort of under the hood. As I mentioned, return on invested capital, we want to see a company's ability to reinvest that capital at a high rate of growth. The best compounders that we found have found a way to reinvest that capital and generate further growth. Once you have that, you've got a company that really has the ability to accelerate its ability to grow. Okay, so early stage of discovery. This is what we look for when we're looking at these nano caps, these small microcaps. We want to see no or low analyst coverage. We actually then search out the bulletin boards and social media. We want to see low social media discussion. Think Twitter, think Seeking Alpha, all those things. It's actually a good thing when nobody's talking about a stock. We want to see low or no institutional ownership. And of course, no or low promotion. We don't mind all these things coming together after we own it, but before we own it, this is pretty key to find companies that are mispriced, right? So small size usually does another thing. It keeps some of the bigger players out, right? The big money tends to have to wait until it gets bigger and bigger, which is pretty obvious. And then the small companies that are unknown have the greatest potential for margin expansion. So when you get these companies that turn into 100 baggers, you need 2 things to really work for you. You need that revenue and earnings growth, and you need that margin expansion. That comes from that discovery process that I talked about. And retail investors really don't understand that this is the biggest advantage they have in the market. This ability to basically buy before the institutional and bigger players buy. And it's amazing how rarely they use that advantage. Okay, so this is an example. This is one of many stocks that we've invested in the past, and it sort of categorizes the different stages of discovery that we talk about. So for those that may know this company, it's called Bioscience. It's been a successful microcap. It's still listed, generating a lot of cash. But we're not shareholders of this at this time. But if you go back to late 2011, this company had sort of toiled in obscurity for a long time, even though its financials were actually looking pretty good. That point there where it says Discovery Catalyst, that was just one earnings statement that I guess really triggered the market. And we saw a big spike in share price at the time. It's hard to see a big spike, but trust me, the stock went up about 50% in one day. And it was enough for us to understand that people were starting to really figure out that this company existed and what they were up to. So we call, up until that point, we call the pre-discovery process or sort of portion. That second portion, the catalyst. So that catalyst now kicked in, and more investors are slowly starting to find this company. Typically, though, it's the smart investors that are looking, right? So nobody's going out there and talking about it. No, there's no promotion in this company whatsoever. There's nobody out there actually, highlighting what's happening here. Slowly, sort of the retail audience picks it up, and we go into that third phase, and we start to see this retail catalyst, and more people are talking about it. And sure enough, the stock starts to move quite aggressively. But what gets interesting is then you get institutional discovery. And that's when the institutions can finally actually start to buy the stock. And it's typically the smaller institutions, and then it grows into the larger institutions, and you get a really strong move in share price. Now, this is where the stock goes from 8 to 10 times earnings to start trading at 20, 25 times earnings. Institutional investors now are getting to know the company. Analysts might start to cover it. It might be on BNN, it might be on CNBC. It starts getting talked more and more in the institutional circles. And you see the stock go from when we first found it 8 times earnings, eventually it hit 50 times earnings within about 2.5 years. Business growth was, still the same. All the metrics were the same, but that discovery process moved that stock up to about a 50 times earnings valuation. And then you get what we call post-discovery. Pretty well everybody in the industry now understands the company, knows it, and you tend to see sort of a lightening up of valuation. And sometimes now, because it's priced for perfection, any sort of misstep has a pretty impactful impact on the share price. Okay, and then just a few of the other things that we look for along with the financials and the 4 criteria we mentioned there. When we're looking at these companies, we want to see insider ownership of at least 10%. That gives the shareholders and the management team sort of similar vested interest. We tend to get a little, I wouldn't say worried, but once it starts getting over 40% insider ownership, you get a little bit more concern that that might be a little too tight. Smaller share count is better. We want to see management teams that treat their shares like gold and not toilet paper. You want to see companies that are really emphasizing, their capital markets and their share count. What we've recognized over the years is if a management team treats their shares well, it typically means they're treating their other resources well as well. So that's staff, cash, pretty well everything else that you need to run a business. So it's a real key thing for us is to see how they've managed their share count. We love simple businesses. The simpler, the better. A simple story is easy to tell, right? Complicated stories may get some people excited, but a simple story is easy to sort of replicate and tell. And then the last thing we do is we really try to understand that shareholder base. Think of the example, if Bill Gates were a shareholder in a small microcap company, how different that message is than a whole bunch of retail investors that really have no sort of experience in technology. Okay, so a little chart porn here. These are past examples of companies that sort of fit the criteria I just mentioned before, and in some cases, some of the companies we've actually owned. Okay, MTY Food Group. I'm sure a few of you know this company. Back in 2003, this is a company that they put together those small sort of restaurants, fast food restaurants in malls. That's Chinese restaurants and sort of specialty food restaurants. Profitable back in 2003, the stock was trading at 30 cents. Fast forward 20 years later, you would have made 220 times your money had you bought that stock back then. Profitable, boring business, low tech, easy story to tell. All the criteria we mentioned in the past fit the position here. Boyd Group. Here's a company that does something just as boring, auto body shops. 2006, low of 84 cents, profitable back then, very low multiple. You would have made 290 times your money had you held that stock. My favorite, Exel Technologies. I bought this stock at 17 cents. back in 2013. So in 10 years, the stocks returned 486 times that purchase price. All these companies were not covered by analysts at the time, growing very rapidly, profitable, and met all those criteria we were talking about. So these are the kind of results you can get by following that kind of criteria. Now, they don't all work, but you just need a few of these to cover any losses you've got in some of your other stocks. Okay. So current examples. These are a couple of companies that we're following right now that meet that criteria and, are not, 10 or 20 years old. By the way, these are not buy recommendations, sell recommendations. These are just examples I want to give you. So Ibex Technologies, back in 2016, we highlighted this. This is a company that met all that criteria that I mentioned. They're a manufacturer of specialty products for life science, the life science industry. We highlighted at 11 cents. This company was trading at about 6 or 7 times earnings, I believe, at the time. Had you bought it at that time and held it to date, you're up 973%. This is a very recent one. We do own shares in this company, Cannabis Capital. By the way, this is the first cannabis stock that I've touched in the last 10 years of all the hype and everything else. This is the first one that we saw that turned profitable. We jumped on this just in January at 11 cents. The stock's at 27.5 cents. Very profitable. Meets all the criteria that I mentioned earlier. We're up 150% on that stock to date. DRX, ADF Group, very boring business. They make steel structures. This company was one that we put out 2 lists every year. One's called the Cheapies with a Chance, and the other is a takeover candidate list. This made our takeover candidate list. It was trading below breakup value, but it was growing, met all the criteria that we mentioned. Had you bought it at the time, you had to wait a few months, but we're now up 104% on that. I personally have no position in that stock. Okay, Total Telecom, another example. This company has been sort of toiling in obscurity for a long time. We highlighted it recently at 16 cents. Just a couple of days ago, a stock hit 50 cents. We're up 213% on this one. Now, I own shares, and I like this company so much that I joined the board to help them basically get more discovered. Total Telecom. Another example of a company I joined for the same reasons is a company called Atlas Engineered Products. All these businesses are quite boring. This is a company that actually makes prefabricated components for the wood frame construction industry. 2017, we highlighted at 25 cents. Just recently hit $100.20. You're up 376% on this company. Okay, so just to summarize, my goal here really was to sort of give you guys a sense that this is not a there's a lot of pessimism in the market right now. There's phenomenal opportunities in the space. The Canadian market has delivered some amazing returns if you know how and where to look. So the concentration should be on smaller, fast-growing, profitable companies. They've been proven to outperform. Read what works on Wall Street, and you'll see what I mean. To be successful here, you have to have a repeatable system to search for these type of stocks. You have to have a proven criteria set, which we believe we do. You have to understand that discovery process that I talked about. I think the more time you spend really understanding that, the more successful you'll be in this microcap space. Of course, you need time and patience. The 3 stocks that I showed you back that returned 200 plus, every single one of them had at least 2 or 3 times in their life where they saw 50% drop in share price. You have to understand what you own. You have to have time and patience to be able to let this thing work out. And of course, buy and hold does not mean buy and forget about it. You have to constantly monitor and make sure the company continues to meet the criteria you're looking for. So that's kind of it. If anybody is interested in our process, we're prepared to give you guys a 3 months sort of free trial just to test it out. There's no obligation whatsoever, just to understand what we're doing. Just use the code word Planet MicroCap. You can ask me any questions. I can set you up and we can help you out. Trevor, really no obligation. Just want you guys to understand what we're doing. And that's it. That's how you can contact me. I'm very active on Twitter. I'm around here. I'm going to be here for the next 2 days. If you have any questions about our process or what we do or anything Canadian microcap wise, I'm here to answer any kind of questions. Yes. What? Sorry, what do I think of BlackBerry? It hasn't shown up on our list. So one of the things that we do when we're looking for companies is we don't sort of attack a company and try to analyze it. We look for all the companies that meet our criteria. So what Trevor and I do is we actually go through SEDAR filings every day. And if a company doesn't meet our criteria, we don't even look at it. So whether it's BlackBerry or any other company, especially the bigger ones, we know that they're not going to meet a lot of our criteria. So we tend to spend very little time on those. Yeah, we're trying to find companies that nobody's ever heard of, right? I think everybody in here has heard of BlackBerry, so we tend to shy away from those type of companies. Yeah. 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 This probably goes against what a good financial advisor. So the question was, how do I manage portfolio weightings, especially if a stock takes off and hopefully goes up a lot. It's like I'm not afraid to concentrate a position. My biggest mistakes in the past have always been I've sold stocks, good stocks too soon. I've actually now, the way we work is if we find a company that's actually performing and continues to hit the criteria, we add to our positions. Like typically we'll add to our winners and we'll cut our losers as fast as we can. So, like I said, I go against what a good financial advisor would tell you to balance the portfolio. We don't do that. We stick with our winners as long as we can, and we cut the weeds and we water the flowers, right? Is there any other questions? So actually, our biggest trigger usually, we try to hold between 5 and 10 stocks. Our biggest trigger tends to be that we find something else that allows us to sort of to replace it, right? So we use the hockey analogy. We want our best 5 players on the ice at all the time. So now if a company drops its criteria, like all of a sudden if it's not growing, it's not meeting our criteria, then that's the reason to sell it as well. And sometimes that means, it's gone from 25 times earnings to 60 and we can't justify that valuation. So we'll sell it there as well. So we'll start, we start sometimes some small positions. So, it's not unusual that we'll get up to 15, maybe 20, but those sort of last 5 or 10 are typically starter positions. Yeah. And we never buy the whole position day one, right? We tend to buy a starter position and then we will wait for execution, more comfort, and then we'll start adding as that happens. But we never ever buy our whole position day one. Yeah. You're welcome. Yes.
Do you have a newsletter?
Yes, we have a newsletter. Yes. Thank you. A big part of what we do, we send something out every week. When we find something that's interesting, obviously we put a report together and send it out. But what we do, probably the thing that our members are most excited about is these lists we put together. So like I said, cheapest with a chance, we put that out at least 2 times a year. What we do there is we literally go through every SEDAR filing in Canada and try to find 10 companies that meet that criteria and also are extremely cheap. So that's where we usually find our big winners is we've done that sort of research and find the 10 best that fit that criteria, and usually surprisingly there may be names we've never heard of before, so it's nice to go through there. And one of the reasons we don't use software, right? A lot of people ask, well, just use software to screen for these. You want to find the ones that fall between the cracks, right? You want to find the ones that the odd doesn't get picked up by that software, because that's the one that's most undiscovered. And I go back to Expel. That's actually how I found it. Most software screeners weren't picking it up. Okay. There's not enough time here today for me to vent and complain about SEDAR. Yeah. No, we haven't found that backdoor wormhole or whatever it is. Yeah. Now it's kind of a blessing too, because it's so bad in our mind that it's preventing a lot of people from doing the work we do. Yeah. So it sort of lessens the competition. Well, we've started. Trevor sent a letter and we'll see what that does. We'll go and picket their office here pretty soon. All right, I'm being told to wrap it up. So listen, I want to thank everybody today. I hope you guys enjoyed the show. This is a fantastic opportunity to go and discover new ideas. So I'm busy today and tomorrow, but if anybody has any questions, anybody wants to say, ask me anything, or if there's any way I can help, please let me know. All right, thank you so much.